Good afternoon. My name is Josh, and I will be your conference operator today. At this time, I would like to welcome everyone to the Halo Labs Q1 2019 call. All lines have been placed on mute to prevent any background noise. After the speaker's remarks, there will be a question and answer session. If you would like to ask a question during this time, please press star, then the number 1 on your telephone keypad. If you would like to withdraw your question, you may press the pound key. Thank you. Mr. Kiran Sidhu, founder and CEO of Halo Labs, you may begin.
Thank you. Good afternoon, everybody. Halo Labs today reported record Q1 2019 revenues of approximately US $8.7 million. That put our revenue up 190% approximately from Q4 2018. When we compare that result to Q1 of 2018, the quarter ended March 31st, we reported revenue in that quarter of approximately $2.2 million USD. What has really fueled our growth over this first quarter has been our entry into the California market. And we believe that on a go-forward basis, our revenue will continue to accelerate as the California market continues to accelerate. Our primary business objectives for this year, 2019, include finishing our California build-out, principally by launching our second Cathedral City location, which will thus increase our overall capacity to supply bulk distillate, shatter, and live resin. And it'll also give us the ability to deliver directly to dispensaries and white label partners. We also want to increase the distribution of our Gilt and Hush branded products into California dispensaries. Currently, we're in approximately 50 dispensaries, I believe, and that's principally in Southern California. And we plan to increase our distribution into both Central and Northern California during this second quarter. There are approximately 550 licensed dispensaries in California. That number we project to double within the next 12 months. We also want to focus on manufacturing and selling higher margin products like dab-tab tablets and edibles in California and Nevada. And in Nevada, we want to increase our distribution, and we've done that by overhauling our sales force in Nevada, and we're seeing already improvements in margins through the sale of higher-end products in Nevada. And we're expanding our facility in Nevada here in Q2 to enable us to extract biomass into distillate using ethanol extraction. In Oregon, we're continuing to see what I call shoots of green or margin improvement. And in Oregon, again, we're launching more innovative products. We plan to launch in Q2 actually a clear concentrate line, which is unique without chlorophyll in the product, that actually smokes better and is much cleaner. It's just generally a much cleaner product. And we hope to see continued margin improvement in our core manufacturing facility. In Oregon, we had rapid growth in Q1 as well, and we weren't ready for it. So we incurred in Oregon a lot of overtime and rushed expedited testing costs. And as we're gearing up people and rationalizing our testing, we feel that just logically our operating margins will improve. We're continuing our international growth trajectory with our Lesotho facility, which sits on 200 hectares with the first 40 licensed, and the first 5 we plan to plant later this year. Keep in mind that the seasons are opposite, so planting there would take place in our fall. We also are entering the CBD market with a facility in Oregon close to our Medford facility. And there we're going to be producing CBD distillates and isolates. I want to emphasize that there it's not a greenfield project. A lot of this was at the request of some of our existing clients, and then some of our existing farm partners in Oregon have high-quality hemp contiguous to our facility. In terms of financial highlights, I went over the revenue figures and the 302% increase. But specifically, looking at our cost of goods sold and our gross margin, at A&M, which is our Oregon operation, we achieved a gross margin of about 8%, and we expect that to improve throughout the year. Coastal Harvest achieved, which is our California operation, a margin of about 40%, 39.7%, and our Nevada operation was a 4% margin, but I want to caution on that because we use FIFO accounting, and a lot of that margin was residual or older product that we bought at much higher prices that we had to effectively sell out during Q1. So we just see from an accounting basis, Nevada margins improving. Our margins have benefited from an efficiency drive, that was implemented at the end of 2018, but in a sense, we in Nevada and in Oregon became overly efficient and had a little bit of a lean issue, which also resulted in, as I explained before, a little bit more overtime and higher testing costs. The biggest driver, again, was Coastal Harvest, in which we achieved an EBITDA contribution of about $1.9 million. But that was offset from losses that we continue to have in Oregon, which were approximately $618,000, and in Nevada, which were about $300,000. We also incurred about $18,000 of expenses in a facility which we call Ireland, which is our second planned Cathedral City facility, which is a couple of 100 yards away from our existing facility. In terms of the cash situation in the quarter, we raised a bridge that was funded principally by the founders and some of the founding shareholders of $1.7 million, and we ended the quarter at $361,000. But by the time we ended the quarter, we knew that we had the convertible debenture offering of $18 million coming through. And of that $18 million, approximately $4 million has already converted. So I think the outstanding balance on the convertible debenture is $14 million and growing smaller. The only other thing I would like to say is that, obviously our capacity in oil exploded. And so we had a 280% increase in the number of grams we sold. And we achieved a price increase in all of that in an aggregate of about 6%. Oregon alone increased grams sold by 28% with increasing prices. And we didn't see that at all throughout last year as prices deflated in Oregon. So that's what I call a shoot of green in Oregon. Gross margin, as I emphasized to you before, in Nevada was temporarily deflated due to high inventory costs of oil as a result of FIFO inventory accounting. So now we're sourcing distillate for a lot less. Distillate pricing dropped from $19 to $20 to $14 in Nevada, which left more room on the retail shelf as retail prices remain fairly sticky. Nevada suffers from a lack of biomass, which has driven pricing up, and high cultivation taxes. Just in terms of an outlook, California continues to be our driving force, as I've emphasized before. New proprietary products, such as our DabTab tablets that we've licensed from Elo exclusively in California and Nevada. And we're clipping now at an annualized production rate of about 25 million. We expect to announce or release new distribution agreements both on the bulk and branded side in California. We've already signed bulk supply agreements with Falcon and Elanca Farms, which was formerly Canis Partners. And consistent with our prior guidance, the company has launched and is on pace to introduce higher margin Oregon product offerings, and then into the Nevada and California markets as well in Q2 2019. We've also launched edibles. We have a lean line of edibles, as I call it. We have a single-piece chew, and we have a syrup-based drink. Currently, that syrup-based drink, we're launching into smaller formats to increase product assortment in the area. Just to give you a little bit of a recap, our DabTab Dablets, we announced on February 26th that we launched them in Oregon, and then we followed with launches in Nevada and California. The dab tabs provide a cleaner and smoother, mess-free way to consume full-spectrum cannabis oils and concentrates, and they capture the full benefit of the plant. And what we found when we launched it was that we were getting what we expected, which was a conversion of concentrate users or dabbers into dab tabs at the rate we thought, but we weren't getting a conversion from vaporizer users, which is the majority of the market. So Elo designed a product that we announced called the DabTab Go that basically effectively replaces a vape cartridge on a standard 510 thread battery, or what's known in the industry as a mod. And that product is launching in the next 30 to 45 days, and we think that's going to really help the product as it allows people who have 510 thread batteries, which is almost any cannabis consumer with a vape pen, to use dab tabs. And then they'll be able to experience a full spectrum effect and a better product than you can get in a vape cartridge currently. In terms of the CBD business, as we all know, the CBD market is huge. According to the Brightfield Group, it's expected to grow at a CAGR of compound annual growth rate of about 147%, reach $22 billion. There are many entrants in it, and in typical Halo style, we're starting small with a facility, that hopefully will be contributing operating profit pretty quickly in the Emerald Triangle in Southern Oregon. And we just want to handle a modest 10,000 kilograms of hemp per month, and it'll yield somewhere between 700 to 900 kg of high-grade distillate or isolate, which is currently going from anywhere between 5,000 to 7,000 a kilogram on the low end. And as I said, we have many high-quality hemp farms around us, both on the California side and on the Oregon side. There aren't the same difficulties or prohibition, quite frankly, of transporting THC product among state lines. So we see a nice business there. It's not like a huge business where we're planning to compete with all the big boys. It's basically an adjunct business that we plan to service our existing clients and potentially a few new clients. In terms of capital market activities, we recently uplisted to the OTCQX, and we're part of the Horizon U.S. Marijuana ETF. It trades under HMUS for Canada and HMUS.U for those of you who want to invest in U.S. dollars. As you know, we completed our NEO listing. Seems that other people like Columbia Care and a few other companies I'm hearing are in the pipeline to join us. This exchange brings much better transparency. As you can see with our quarterly numbers out before others, it brings pretty quick reporting. The other thing is that we're also, the other thing I wanted to point out, which we haven't pointed out, is that looking at the New Cannabis Venture database and analyzing, all the U.S. publicly traded players who are, basically plant touching. If you look at the U.S. plant touching cannabis stocks, and you look at those that are publicly traded, either on a U.S. exchange or on or on the Canadian exchanges, and you look at reported revenue, not projected revenue, we are in the top 10 in that category. But the irony of it is, as always, our multiple is substantially less than the other 10. Obviously, it's led by TrueRelieve and Planet 13 based on our analysis, which we'll be posting on our website in the next couple of days, is number 10. Our quarterly revenues are $8.7 million, which if you annualize is $35 million, and where we close today, it's around a 3.8 to 3.9 enterprise value to revenue multiple. The other thing I would want to emphasize is using that same database is that we rank second among U.S. plant-touching cannabis stocks based on revenue growth. So the number one stock is Tilt, and then you have a whole bunch under us. But the critical thing about our growth, which was 190% quarter over quarter, and as we said, about, excuse me, too many numbers, about 190%, quarter over quarter, and over 300% year over year, is that when I look down this list, our growth is all organic. So we haven't acquired revenue, we've grown revenue, which has been more accretive to our shareholders. Yep, and that's it.
Great. Well, with that, Kieran, we have a couple of questions that have been submitted via email. So I'd like to pose those before we turn it back over to the operator for some of our attendees and their questions. So first, the first question here that we received is the outlook for Q2, the rest of 2019, and into 2020.
Okay. So in terms of Q2 outlook, we do not provide quarterly guidance. In terms of 2019, we're currently estimating net revenues of $47 million. All our figures are in U.S. dollars, of about $47 million. We believe our gross profit by the end of the year will be $15 million. In terms of EBITDA, we still believe that we'll be negative at about $2.5 million. But I would say that I would anticipate by Q4, we will be EBITDA positive. In terms of 2020, right now we're estimating revenue of about $102 million. And it's not a big leap to think about that because it's principally based on the growth of California dispensaries. Our view is that, as I said before, the California dispensaries will double, which I think is conservative, within the next 12 months. So $102 million of revenue, gross profit of approximately $35 million, and EBITDA of $20 million as we hopefully enter Q4 with a positive EBITDA trajectory.
Great. So I guess this goes without saying, but perhaps you can elaborate just a little bit more. Do we think the company will meet the $50 million U.S. revenue target this year and perhaps achieve even more revenue?
I'm not going to comment on the more revenue, but right now on an annualized rate, we're at $35 million, and we're growing at a good clip. So I think that $47 million number is a realistic target.
Great. Well, I guess I'll answer this question. Do you think Halo could be a takeover target? So I think, the management here, we definitely believe there is rapid consolidation in the industry. At the same time, though, we think we can substantially increase revenues month over month while increasing gross profit, which, of course, Kieran commented on during this call. So while we aren't looking to sell the company per se, we are, of course, always looking to maximize shareholder value. And so to that effect and to that end, yes, we believe we could be a takeover target, although our current priorities are to just continue executing our plans.
Anything else?
Karen, yep, here's this next question here. It's a kind of a follow-up to that one. Perhaps you can answer it. Are there interested parties which have approached the company?
I would say that this industry is a pretty tight industry, so there are always continual discussions among the players. That's all I would say.
All right. We have a question here on expansion route and whether that should be via takeover of private or public companies. I think the way we think about it is that we rely on organic growth. However, it's in the best interest of our shareholders to evaluate both private and public opportunities. But the ways that we look at it really is by how it affects where we operate and our strength of operations. So the first bucket would be smaller acquisitions, tuck-ins to consolidate our position in our existing markets. And then we have transformative opportunities in our existing geographical footprint. And then, of course, transformative to widen our geographical footprint. And, we really are open to each kind, but I think probably the first and second are the ones, particularly the first that we focused on, most significantly. Karen, what else do you have to add to that?
No, I think that's a fair assessment. Yeah.
Okay, great. In terms of other states of interest, because this is another question that we got, asking us about other states, I think, again, we're really focused on the areas sort of either in our existing geographical footprint, which of course is Nevada, California, and Oregon. So to that end, Arizona makes sense to us. The west coast of Canada makes sense to us. Washington State, to the extent that residency rules relax, potentially. And then on the flip side of it, though, of course, we can't ignore a market like Florida, for example, given the attributes of growth, although it is on the East Coast, and it is still an attractive market, so that's the way we think about it.
And obviously there's Canada.
Sure, Canada, absolutely.
But we've sort of shifted our emphasis to be able to do something on the west coast of Canada, BC, maybe Alberta, as opposed to doing something on the East Coast, to keep contiguous.
Absolutely.
Keep our operations contiguous and keep our people moving among our operations.
That's right. Okay, great. Now we have a question here, Kieran, I don't know if we can answer this, but there is a question about the DAB tabs and the contribution margin of DAB tabs.
I would say that they're higher than the other products we do. We won't disclose what they are, but it's the type of margin you would expect from a proprietary product platform.
Great. Okay, and this question is about all of the good news and the exciting press releases we've had, yet at the same time the share price is not always reflective of this. This investor pointed out, or this question pointed out, the valuation, maybe it should be higher. So Karen, what do you think about that?
Well, it's something that's been of interest, and it has to do with getting the story out. And when I sat there and analyzed this with my chairman, Scott Patterson, what we noticed was a trend that we were unaware of, and that is it seems that our U.S. peers, in that top 15 list where we rank 9, when we looked down the list, what we saw was that most of their volume is coming from their OTCQX listing. It's not coming from their Canadian listing or their German listing. It's coming from their OTCQX listing. With us, most of our volume is coming from our Canadian listing. So where we've been poor as a team is not getting the story out in the U.S. So we're going to be spending a lot more time trying to get in line with our peers and generate more volume through the U.S. exchange, the OTCQX, while maintaining our volume that we have both in the European exchange and the Canadian exchange. So I think it's really key that U.S. investors are now sort of investing in Canadian, even though we're U.S. companies, we're Canadian corporates, are investing in them. And the other thing I learned in this exercise was that there are approximately 90,000 brokers in the U.S. that have the capability to buy our stock in the U.S. list, through the U.S. listing.
Great. And then in terms of this question is now the company that we identify as a direct competitor of ours in the extraction field. What revenues are they currently doing, or their market cap, some sense of their valuation?
So in terms of a company like us, there's only one company that's really like us. They have an identical footprint to us. They started in Oregon just like us. We actually expanded to Nevada together and then split. And then they moved into California before us. And that company's name is Cura Partners. Their founders and owners we know very well. And Cura Partners was recently announced a binding acquisition deal to be acquired by Curaleaf for $950 million USD. Their sales are obviously more substantial than us. Last year, I believe they did about $120 million. Knowing them, they're probably on course to do $150 million. Our sales are about $50 million. They were sold for $950 million on, let's say, $150 million in sales. We probably will do about $50 million or $47 million, and I think we're currently trading at about $125 million.
Right.
So yeah, there couldn't be a more identical comp than them.
Right, and the numbers really speak for themselves. So, and in terms of sectors, because we talk a little bit about not expanding our focus, but adding complementary businesses like CBD, for example. What do you feel is the biggest opportunity, THC or CBD, one or the other or both, and why?
Well, what's interesting is from a manufacturing perspective, and we're very manufacturing-centric, CBD extraction and making of distillates and isolates and THC are almost identical processes, with the exception of you'd have to run one more pass to do a THC strip on your CBD. So from a manufacturing process, they're very similar. But from a marketing perspective, they're very, very different. And that is because THC, you have to have a license, it's strictly controlled, and CBD is being deregulated rapidly. So again, as I emphasized before, our strategy with CBD is to, use it as an adjunct business. We're not getting into distributing to 7-Eleven or gas stations. We're going to be bulk suppliers to principally our existing clients and leverage our existing farm relationships to mitigate risk.
Great. Well, those are all the questions that were submitted to us, written questions. So, operator, if we can shift it now to the live Q&A session, that would be great.
Certainly. At this time, I would like to remind everyone, if you would like to ask a question, please press star, then the number 1 on your telephone keypad. We'll pause for just a moment to compile any questions. And again, if you would like to ask a question, please press star, then the number 1 on your telephone keypad. We currently have no telephonic questions at this time. I'll turn the call back to the presenters.
Okay, great. Thank you. I just have one last comment to make, and that has to do with a lot of people ask us the question or ask me about extractors as a peer class. And what I'm noticing about that is, we've come up with about 6 or 7 peers in that area, from Next Leaf Solutions, World Class Solutions, Chemsys, Radiant, Neptune Wellness, Valens, and MetaPharm. Most of those extractors are based in Canada. We're pretty much the only U.S. one. Currently, relative to them, we're trading at about 6.3 times revenue they're trading at about 6.3 times revenue, and we're trading at about roughly 2.1 times revenue. But I would, again, caution that as an apples-to-apples assessment because those peers are all Canadian-based, and the Canadian stocks seem to be able, at this point at least, the Canadian extractors seem to be able to extract higher margins, so to speak. And I'll leave it at that. And thank everyone for listening in. And, I see a bright future ahead.
This concludes today's conference call. You may now disconnect.